Hello and welcome to another Breaking the Mould. It's our regular market review show with our investment research director, Russ Mould. Russ?
Yes, tell me.
What's the fuss?
Okay, the fuss in the next couple of weeks is going to be about three things: groceries, sports gear, and, just so you go all gooey on me, chocolate.
Okay, so I'm going to have to leave chocolate to last because that's my favourite.
Yeah,
Save the best till last.
that's okay.
Let's kick things off with groceries. I guess the shadow of Tesco's is still looming large here.
Yeah, and a big black shadow it is as well after the end of August, when we had a second profit warning in 6 weeks from the supermarket giant and the company cut its interim dividend by 3/4 for good measure. Now that mess left the shares at a 12-year low and caused quite a lot of collateral damage, dragging Morrisons and Ricardo down for good measure. Now therefore it'll be very interesting to see what Morris and Ricardo say when they produce numbers on the 11th of September.
Is there no sign to the end of this price war?
No. Not that we can see so far anyway. Aldi and Lidl still hammering away, making a proper nuisance of themselves. There is now a suggestion under new boss Dave Lewis, Tesco's is going to retaliate with knobs on. Analysts are suggesting that given the dividend cut gives them substantial room to cut their own prices and drive Tesco's own operating margin down to 2%. Now that compares to the 6 it was making at the turn of the decade and the 4 that former boss Phil Clark was forecasting or looking for. Now if that's the way Lewis goes, no proof yet, somebody's going to cop it, and the market's expectation is that Morrisons is the most likely sacrificial victim, partly because it's been quite slow, as we've discussed before on this show, with convenience rollout and also the internet. So Dalton Phillips, the boss of Morrisons, heavily under pressure. If there's one thing in its favour, expectations are incredibly low when it comes to their numbers on the 11th of September. Like-for-likes in Q1 were horrid, down 7.1%, and the market's looking for around a 50% drop in underlying earnings per share this year to 11.8p. Now, that leaves the dividend at 13p uncovered. So let's take a look at the interims, at the like-for-like numbers, and also whether there's any talk on the shareholder payout.
Okay, what does all of this mean for Ricardo?
Well, Morrisons, it's a good question. Morrisons has done this big online distribution deal with Ricardo to try and get its internet offering going, 25-year, multi-million-pound deal. Despite that, Philip, Ricardo's numbers are showing a little bit of a loss of momentum. Sales were up 18% in the first quarter, 13% in the second. So let's see what they come out with in the third. I mean, let's face it, that's still way better than the bricks and mortar guys are achieving. But equally, to offset that, Ricardo's kind of borderline profitable. Its shares are at a 52-week low, near as, and so therefore boss Tim Steiner, I'm sure, will be hoping to show a re-acceleration of sales momentum.
Okay, that's groceries done. Let's hot-foot it.
Good.
Boom, 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 onto sports gear.
Sports gear, and that means Sports Direct. FTSE 100 company, first quarter trading statement on the 10th of September. Now, back in July, they published some very, very good fourth quarter figures, and all of that was lost in the noise caused by the argument over a bonus scheme for founder Mike Ashley. He actually politely declined that in the end, by the way, so more power to him. So the operational performance has been very good, driven by the internet, driven by rollout in Europe. And so again, let's have a look at the first quarter numbers. Boss Dave Forsey has forecast around a 10% profits growth to this year. Pretty good going in the retail environment that we face right now. But the shares have come down from north of £9 to about 7, not because of operational worries, just because people are frightened the shares just a bit toppy, a bit expensive. And it's up to you to decide. They still do trade on 19 times forward earnings.
Okay, I'm excited now. Save the best till last.
Yeah, okay.
Yeah, we're going to wrap things up with chocolate. Yay!
Thorntons is the company. It has been a bit of a sticky one in the past. See, it's not just you who can do the gags. And that was mainly for reasons such as the company saying, oh, look, it's been really, really hot, nobody's bought chocolate. Oh, look, it's been really, really cold, nobody's bought ice cream. And also there was a very, very heavy seasonal bias towards Easter and Christmas for obvious reasons. So Jonathan Hart, the boss, came in a couple of years ago and he's largely sorted that out. Cut costs, closed stores, revamped the range, got them going really well through the big supermarkets. And that's been a big success. He's dragged the company back into profit. So let's look at the full year numbers on the 10th of September. Market's looking for 7.4 million pre-tax against 5.2 last year. But analysts not yet looking for a resumption of the dividend that was last paid in 2011.
Okay, Russ, thank you.
Thank you.
I'm going to go and grab myself some chocolate. Perhaps you'll be grabbing yourself some as well. This has been Breaking the Mould. We'll see you very soon indeed. Goodbye.